Well, welcome also from my side. I'm Gregor from the market. You might know us. We're an online platform for financial, actually for investment topics. It's a pleasure to lead this discussion today. You already know basically the presenters, Georg, Marcos, William. He is actually running a French small cap fund and has done that very successfully. I think he has outperformed for 31 years in a row. Which is
some of the 25, from of the 30 years.
Okay. And Stefan is actually running two funds. One is ESG, one is a normal one, which are multi-asset with a strong equity tilt. So just that that we're all on the same information level. But now let's start. I would like to actually start with a question which is based on two slides we have already seen, which is the long-term outperformance of value. Now we actually all know that value had a very tough time for the last, 15 years, I would say. You even said it's like 22 years. It looked like there was some recovery or trend reversal like 2 years ago when interest rates went up and the Fed had to tighten monetary policy. But now that seems to be rolling over again, despite interest rates still being high. So I really wonder, Georg, what is needed that value can sustainably outperform?
I actually think that it's not such a bad time. I think because people are starting to realize that maybe interest rates will stay at current levels for a while, or maybe go up, but they won't necessarily come down. They're less and less interested in that big momentum trade, which is just buy large cap tech and watch it keep going up. Mm-hmm. So I think we're starting to see more interest in normal companies, especially if they're cheap. So
you see that where in your funds or?
Yeah, we're seeing that. Absolutely.
Okay.
It's been, just happened. It's like these cloud bursts that we get. All of a sudden it's raining. Yeah. And it's good. I mean, good rain in this sense, not too much of it.
Marcus, you mentioned actually that even a 25-year cycle could start. I mean, but again, it was like, it still doesn't really feel like that. What do you think is needed?
Yeah, well, when I look to the Magnificent Seven, as I tried to explain, these 7 big companies, these business models are outstanding. They've been growing 20%, 30% for several years. Even NVIDIA now has been growing massively in the past 2 years. There's a moment where, these guys cannot grow much more. And growth, if you look at the consensus long term, is below 10%, which means that 1/3 or 25% of the US index is just peaking in terms of valuation because P's of more than 25%, you need to grow by 10. We own Visa in our portfolio. Visa is trading at 25 times earnings, but it's growing at 10%. I would never buy anything at 20 or more if there's no 10% growth. So there's a moment where 25% of the market, which is technology, and it's a big cap, and it's passive investing, is going to kind of top. And then there's 2 scenarios. One scenario is that they go sideways for a long time, whilst value catches up. Second scenario is the bubble of 2000 and 2099, that we go crazier. Now they lower rates too much, the Fed is wrong, and then we go to a bubble, and then there is a cataclysm, that we saw in the tech bubble. This is my kind of dual scenario. In both scenarios, value will do well. Base case scenario for me is that these Magnificent Seven just sideways for many years. Ones will do better, others like Tesla will do worse, and value will catch up. And then the starting point obviously is valuation. I was looking at valuation of the MSCI value, is trading at 13 times, MSCI growth is trading at 25. So it's, if you look in history, the gap is obviously too large. The starting point is too large.
Georg mentioned actually that interest rates could even stay high. Well, actually the ECB lowered rates yesterday while long-term rates went up, but okay. What do you feel? I mean, would you agree with that view, William? And what would it mean actually for valuations?
For me, you shouldn't put too much emphasis on interest rate. There was a study by Exxon 20 years ago who said when interest rates go up and the US market goes up, the European market goes up. When interest rate goes up and the American market goes down, European stocks goes down. So basically, if the American market is doing fine, the European market will do the same. And the relationship between interest rate and stock exchange is more complex than you would expect. For me, the reason why the American economy, the American stock exchange is going up is just because the American economy is doing well. And the fact that everybody says the stock exchange is going up because the interest rate will go down, okay, it's an explanation, but I'm not sure it's the best one.
Well, Stefan, obviously I know a bit where you're coming from. Do you agree with that view that interest rates or the level of interest rates do not matter that much for the stock market and for valuations? I know the answer is no, but
maybe you can give. No, I would like to quote Warren Buffett, who once said that interest rates are to assets like the gravitation is for the apple. They power everything in the universe, and if interest rates go down, when money becomes cheap, asset prices are going up, and when interest rates rise, then the competition for many asset classes from the government bond side is getting stronger, and there's a certain pressure, and you have to be more selective. So, from my point of view, I think the future will be much different from what we experienced over the last 3 decades. We had a period of falling interest rates, of liquidity which was lifting all boats, and we are entering a period of high fiscal deficits which have to be financed by issuing government bonds, and this will be offered to all of us. Yeah? And I think that the competition for all asset classes will be much harder. I'm from Munich. In Munich we have cap rates, so yields on real estate which are currently around 1 or 2%, while interest rates are already at 4 or 5%. This is simply not sustainable. Yeah? And especially, and this is a good message from my point of view for all my colleagues here, maybe including myself, is that the equity area, especially growth companies, benefited more than proportionately from declining interest rates. Because if you put declining interest rates into a DCF model, it benefits especially those companies who are reliably growing their earnings. Yeah? What everybody loves. But we're entering a period, I think, where you have to differentiate much more between a good company and a good investment. Yeah, and everybody was falling in love with the compounders, with companies with huge moats and so on. And it's understandably if you look into the rear mirror, but the future will be simply different. So I think there will be a lot of competition for equities, for real estate, for private equity investments, which were calculated on narrow margins. And there will be a crowding out effect, especially for those people who are invested close to the index. But that's a good message for our field. We are not, almost all of us, are not invested close to the index. We are on the second road. We are looking for undervalued quality companies. And that might be the spot, not only in the equities area, but also in comparison to many other asset classes.
But Stefan, just one more follow-up question on that. You mentioned that the higher debt issuance will lead to higher interest rates, but won't central banks just buy all the bonds which are issued by the government?
Yeah, that trick worked for many years in a world where there was no inflation. and maybe inflation is coming down temporarily, but at the end of the day, we all know what the governments do. Maybe they will even be so crazy to decrease interest rates, short-term interest rates, because that's what they can control. It's not that easy to control the long-term interest rates. Then you have to initiate yield curve control, and once you initiate yield curve control, then you are making people nervous, because you are manipulating officially your yield, and in an environment where people are actually asking for a premium of on average 2% on long-term yields, in order that it makes sense to invest in 10-year bonds, it simply does not work, and then you have a huge loss of trust, and suddenly your currency gets under pressure, which is also once again a case for equities. Who are productive assets which can protect you theoretically if you don't buy them at too elevated levels, right? Like most of the bigger companies are trading at.
Thank you. Probably on interest rates, just to finish up on that, Markus and Georg, first of all, do you really have a view on interest rates? Do you worry at all? And does it impact your valuation work?
Well, no, I mean, let's put it this way. For us old guys, we're back to normal. We don't make projections on interest rates, but the level of inflation and interest rates that we have now is what we were used to before financial repression came and screwed everything up since 2011. So I think basically we're in a normal world, and we don't adjust our discount rates in that sense. We've always assumed that an equity investor wants to earn 10% over time, and we don't worry about that too much. It's also not so important to get that number exactly right. But basically, we're comfortable that we're back in a situation where, with interest rates at levels that are historically normal, that the value style goes back to working, and then we don't worry much more about that of things. We then look for cheap companies.
Yeah, in SIA what we do is we have a macro scenario, which is not at all a base for investment. It's just we design this macro scenario. We pick the important things or themes for the current cycle, and this changes every cycle. So in this cycle, we picked China, we picked inflation rates, liquidity, and EPS downgrades or upgrades, and we follow that closely. So in inflation, we more or less knew that inflation would normalize, and we said that in our quarterly statement. But then we defined the base case in order to try to see if we are going really to a recession, in order to be a bit more conservative. But we don't change the discount rates. We don't really move if inflation is a bit higher or lower. But yes, we have a central case that now suggests that we are in a quiet phase, in the end of a slowdown. Still, there is risk of recession, because we are still slowing down. If you look to industrial production and to some other metrics and to downgrades, but looks like that if rates start to go down, the new cycle starts. So basically, what we do is try to, look for risks and maybe manage the portfolio a bit more conservatively, but it's very marginal.
Okay, so basically, yeah. What I find interesting is we're talking about value here. It's called Swiss Value Day, and my impression is that there are kind of different value, kind of different schools of value. You mentioned Benjamin Graham with his cigar butts. We heard about Charlie Munger, who is focusing more on quality. So there are obviously no real definitions for that. So I really wonder, from each of you, what is your approach? How do you define value and quality, if that's important for your approach? Yeah, let's start with Georg again.
Yeah, sure. So basically, our starting point is the value of a company. So let's say all of us in this room are rich enough to own, Nestle. What would it be worth to us if we wanted to own it forever? How would we value it? And we try to take that mentality when valuing an asset, when valuing a company, and then we try to buy at a big discount. And so then all of the questions about quality, which usually boils down to some level of stable growth and stability in earnings, all of that gets subsumed into that question. Obviously, something that you're guaranteed, which guarantees you growth and high margins, is going to be worth more than something with volatility. But that would be part of the valuation process, is to take into account those factors.
Yeah, for us, as we started being pure value or deep value, not doing a lot of strategic analysis, now we do a lot of strategic analysis. We try to understand for every stock, we try to know, and try to understand the sector, entry barriers, exit barrier, competition. Then the sector, you go down to the stock, you try to understand the stock, what is the competitive advantage, balance sheet, blah, blah. So we really do a fundamental work that in the end, it's a quality layer. So over value, we build a quality layer, and we only buy businesses that we think will do well in the future, and then sit there. The difference is that we try to buy them at a discount, which sometimes is not easy. To the example of Nestlé. Nestlé now, it's at a PE of 15. We've been discussing ages about the 25 times. Nestlé is now 15, and not a lot of people not a lot of people are buying Nestlé. Then is when we jump in this type of stocks.
So you're buying Nestlé.
So we probably would be buying Nestlé, and in the end, what the portfolio construction, what we do is, as I try to explain, is categories of risk. So we buy not one Nestlé, we buy a basket that normally are in trouble or cheap for a reason, and then so to that we ask a 10% return, categories 2, 12% return, 3, 15% return, and high risk 20%. So the average is normally 14%. And what this allows us is when the market is very expensive, we move the portfolio to non-risk stocks, to higher quality. And when the market collapses, we move to 3s and 4s because they have collapsed already. So this way we can play a little bit with quality and value.
So right now you're more into the Nestlés.
Now we are 65% in 1 and 2s.
Okay. William, what is it for you, quality and value?
For us, life is very simple. Value is a price earning lower than 12. Value is a return on capital employed higher than 18.
Okay, pretty simple. That's it. Stefan, investing can be easy, but not simple.
Okay, I think I'm a value investor in the tradition of Warren Buffett and Charlie Munger. So for me, value and growth are not necessarily opposite styles. It's always about the difference between value and price. A growth stock can be undervalued as well. If a growth stock is cheap, then it's a nice thing because you have this compounding effect, and that is often underestimated, and that's why quality value investing worked so well over the last 2 decades. But it was, as I said, doped by falling interest rates, and now Buffett has the same problem like me. He's not finding any longer undervalued growth quality companies. That's what he stated on the recent annual meeting when he said even if he would have only 10 billion in assets under management, he wouldn't find anything out there, which actually means from his point of view, the top 200 companies in the world are not necessarily attractively priced. So as a value investor, I have to take this into consideration, have to become more eclectic, have to look for more or less obvious quality, where the quality is not discounted in the stock price, and which are hopefully trading at a low multiple right now, because a company which does not reflect a growth is less sensitive to interest rate changes. Yeah, it's called a short duration stock. So I'm a little bit more like William right now, because that's what the environment is telling me is the best way to go.
Where I struggle, obviously there are special situations, but where I struggle is that, stocks which are high quality usually trade at the premium, and you want to have it at low valuation. So for me, this is a bit, it sounds a bit like impossible. So my question really is, where do you usually find such names? And obviously, Georg, you also mentioned that for you, you want to invest in quality businesses. So we start with you again.
Sure. Well, how do you find them? You turn over a lot of rocks.
Yeah.
So you have to look a lot.
Yeah.
But sometimes there's a factor that's hiding the value. So Kelly, it's the management, was hiding the value by spending too much on overhead. Or take another company, which I've talked about a lot recently, which has gone up a lot, which is Wärtsilä. They make those big engines for motors and power plants. They had a problem with inflation. That really hurt them a lot. They had a lot. Their contracts usually run 18 to 24 months. So when they get an order for an engine, between the time they get the order and they deliver it, maybe 2 years pass. And they neglect, because the market wasn't accepting price inflation clauses in up to 2020. They didn't have those in the contract, so they got killed when costs went up a lot in 21. And then that depressed the earnings. But if you assumed that would go away, which they said it would, you could do a bit of math and figure out that it probably would, then you saw that their earnings power was actually a lot higher than what the market was estimating. So that's one way we look for value, is try to understand the companies, what their situation is, and then try to see where there's somehow people are missing something or something's being overlooked.
Yeah, basically, as I tried to explain, we have a watch list, which is an entry barrier to the fund. And this watch list, we focus in industries that we like, that normally are good industries, in our opinion, for the future, like, aerospace, or semiconductors, or software, so cables. So we have 20 sectors, subsectors defined as we want to be there, and most of them are quality, obviously. Something that we learned in 2008 is that we don't want to invest in bad businesses at all, at any price, because they are full of bad options. So businesses where entry barriers are too low, where over the cycle return on capital employed is below the cost of capital, we don't invest in them even at half replacement cost. That we learned the hard way, because these bad businesses, you have bad management, you have things hidden in the balance sheet. So taking out bad businesses, basically there's three baskets. It's quality, then there is a cyclicality, and you can buy cycle when it is very cheap, but with businesses that are generating value over the cycle, and then you can buy quality, like now Nestlé is 15 times, Reckitt Beckingser is 14 times. So you have these companies that from time to time, they have problems. Viscofan, we are back to a company that it's historical for us. These guys do the casing for the sausages. We were in Devro, that was taken over. Now we are back with Viscofan. This is a quality company that I don't know why, some profit taking, or profit warning, whatever. The stock is down, maybe the interest rates call, and at some point it's at P of 15, and then we buy, because we think it's worth 22, 23 times. Yeah.
And for you, what you do should not be possible, no? To buy high ROEs at...
Okay, we look at historical data, and it just happens that 95% of fund managers are seeking growth stocks, which means it's rather easy to find companies which are undervalued when you look at historical data. And that's it. People want to invest in companies which are growing at more than 10% for a year. If you accept to invest in companies which are growing slower, you will get many opportunities, which we have.
Stefan, you mentioned before that you have to move away from the larger caps to more niche areas. What are these?
As very few companies attracting so much money, of course, they are leaving almost everything else relatively neglected. And there are also quality companies in the second and third rows. And we are focusing primarily on service companies which are dominating a certain local region. Yeah. For instance, a moving truck company called U-Haul In the US, they have a 60% market share. Next competitor has 9% market share. And very stable business, family-owned, free cash flow yields, normalized because they have a CapEx cycle. They're investing in storage facilities, which are nicely to combine with this kind of business. So they have free cash flow yields rather in the direction of 8 to 10%, while L'Oreal or Microsoft, they are trading at 2% free cash flow yields. Yeah, 2% free cash flow yield you are getting out of an investment in Microsoft, and it only works because analysts are calculating with 15% in case of Microsoft for a very, very, very long time. So they're speculating about the future. And I think what also all unifies us, we like to have the bird in the hand. Yeah, we like to have cash flows which you can feel and taste, yeah, which are not too far away in the distant future. And if something goes wrong with the growth rate, you still have your normal cash flow coming in, and the downside is much lower. Yeah, if you focus on quality, and there still we look for pricing power, we look for modes, but hopefully underestimated ones, because that's what you need to look for. And that also brings us into the game, because I think active investing becomes much more important in a world where cost of capital are on average much higher, and which makes investing in general a little trickier than it was the last 3 decades.
Yeah. William, back to you. I still wonder, how exactly are you doing it? Are you just screening and that's it? Or do you analyze the businesses?
Okay, we start doing some screening. We find, let's say, in France, there are 175 companies which are quoted. If you look at companies which have a high return on equity and a low valuation, you will find something like 100 companies. If you analyze them, you will get to 60 companies. And basically, we have 42 companies out of the 60s. And we speak to the management and so on. We make some predictions. The difference between what we do and what others probably do, because we don't know what they are doing, we don't believe in our own predictions. We don't believe in the others' predictions. So we want to have a big discount compared to a simple story. What happens if the growth of the company is very low? And basically, if the price is too low compared to a low growth, we want to have some growth, we buy it. I will present a case in which it's almost impossible to make a prediction. But the price is so low, we are rather comfortable with it. And I did present this case because I wanted you to be sure that basically we don't believe in our own predictions, and we believe that to invest because you predict something is rather risky.
So, I mean, why do you predict at all? First question. And the second one is
because I want to understand what the others do.
Okay. And the second question is, I mean, you mentioned that you value a company. So how do you evaluate when you don't do predictions, or when you do predictions you don't believe?
But okay, if I want you to laugh, when there is a due diligence questionnaire, sometimes we give 200 pages plus appendixes, but nobody in his right mind asks us what were your predictions 3 years ago, so we can compare it to reality. Everybody knows that the last predictions were completely wrong. And you don't select a fund manager because he's good at predicting the future. Basically, nobody is able to predict the future. That is bad news. The good news is if you are nobody is able to do that, and you know you are not able to do that, you probably take better decisions.
Georg, your way around predicting the future is kind of normalizing things, am I right?
Yeah.
Yeah.
I think if you're going to buy a company, there's an implicit prediction in there that they're going to survive.
Yeah.
So we start with that. We start with that. I guess
Well,
the question is, what are we talking about predicting? I don't predict inflation. I don't predict unemployment. We don't know how to do any of that. But if we think that people are going to still consume certain products or services, then I feel comfortable saying, yeah, we're going to eat in 2 hours and we're going to eat tomorrow. So food companies are going to sell us things. So we'll take that as a prediction. Then the question becomes, how fast do they grow? And there, of course, you have to be careful. The way we do it is we do make forecasts for growth, but we make we make a bunch of forecasts. We'll do 3 forecasts for a division: a bad case, a base case, and a good case. And those are based on historical trends. So if a company's grown historically at 4% and there's no reason to think that their product is going to disappear and blah, 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 then you can continue assuming 4% in the future if you understand where the 4% comes from. So a lot of our work is trying to understand that and then say, okay, and then management says because of this and that, they'll grow faster. Then that, okay, does that make sense? What can they do? Then we talk to people in the business, in the industry. Maybe we get some confidence in that. And then we can either raise our base case or we say, okay, if things go really well, we have a high case that's this high. But yeah, we can't get around making predictions about what's going to happen. If the future was complete blackness, then I don't think I'd be in the investment business.
But it's more like based on what happened in the past, like as you mentioned.
I'm not going to predict which kind of phone I'll be using in 10 years. Right now I have an iPhone.
Yeah.
And that's my problem with the stock. I don't know if I'll have an iPhone in 10 years or if I'll even have a phone. That's the problem with tech, is it's harder to make those predictions. It's pretty easy to predict we'll still be using Excel and Word. Because we bloody well have been. I'm of the generation that used to say, oh, Word's not as good as whatever, Word perfect. And yet I use Word now.
I think, Stefan, you have a pretty similar approach in terms of you don't really predict, you also normalize. Probably you can lose a few words on how you're doing your valuation work.
Well, it's something which unifies all value investors. They think about margin of safety, and they think in terms of average future conditions. And because if you're predicting free cash flow yields for the future and then you're discounting them and you're coming up with you have to have an assumption about the future, right? You have to have, at least you have to have the assumption that it's similar like the past. But as I said, I think the future will be different. Interest rates subsidized companies' earnings a lot. Declining tax rates. There's a study from the Washington Fed which came out last year, which said that 40% of all US earnings growth over the last 20 or 30 years can be explained by falling tax rates and falling interest rates. And we have to ask ourselves, will still be the case for the next 20, 30 years, especially when governments are asking for our money in various ways, not only by issuing bonds, but probably we won't have any support any longer from the tech side. So I'm a little bit concerned. For instance, I'm paranoid. I'm a risk manager. I try not to lose money first, and then I try to make yield. But I'm a little bit concerned that the future is a little bit more difficult. Yeah? And tax rates will increase. Maybe not everywhere in the world. Maybe in Singapore the tax ratios will not increase, or in Norway, because they don't have a debt problem. So maybe that is something I could build into my calculation and look for cash flow machines we all like in Norway or in Singapore, right? Which are generating stable currencies on top of that, which and that is something I think could make sense even for a value investor to integrate into the game.
Marcus, I have 5 minutes, sir. Okay, good to know. Actually, Marcus, probably I know that you do some DCF work, discounted cash flow work. So you obviously do some predictions. What would you reply to William? Who says, "Oh, nobody can really predict."
Yeah, we are not that dissimilar.
Yeah.
So
Yeah.
if you go to growth above 10%, I don't touch it. So people that estimate that growth above 10% forever, this for me I cannot really. So for me, growth is 10% or less.
Yeah.
So a quality company like Nestlé, to take the same example, is going to grow 2% prices and 2-3% volumes. It has been doing so for 30-40 years, and the margin has been 15 to 16% for 40 years. So really, you don't need to do that much, right? So this is the quality where we move. Kind of not very high growth, kind of 5-6%, sustainable with visibility, and the modeling is super easy. Then you have other companies that are more complicated. Visa, for instance. Okay, Visa. Why do you own Visa? Visa, it's PE of 25 times 2025. It is a 4% earning yield. Growth is 10% or more. And we think this growth is accelerating. Why? Because e-commerce, because cards payment, because payment through the web, and all these new payment systems. We think that they have the network, and they will keep growing 10% for at least 10 years. You can do a dual model with two phases of one 10%, one 5%. Anyway, if they grow 10% and the yield is 4%, your internal return will be 14. But this, for us, is a maximum. So and then for cyclical stocks, we do not assume growth. So for cyclical stocks, we assume a very little growth, like GDP, less than GDP, and that's it. And then we buy them at a big discount. So we are not that different, because basically our DCFs are pretty common sense. Maybe the thing that differentiates us is that we converge the models, probably similar to Georg. We try to see what is the long term of this business and this company, analyzing the structure of the business and the company, which means that sometimes we disagree on what is the margin long term and what is the return long term, and then you have a competitive advantage, because if this business you think that return capital is going to be double digit or single digit, the valuation changes a lot. But this is not a number or a modeling, it's more a strategic analysis. And here we differ. We apply that to commodities. And in commodities, we have a structure where we are able to define where the commodity has to be on a supply, undersupply, or oversupply scenario. Incentive prices, we know what is the price, and then we derive the model. We converge the model mid-cycle, and then we have an advantage that we have an anchor. What should be the mid-cycle valuation? We buy here, and we sell here. And there's a lot of people that do not even know what the incentive price is. So here, I think modeling helps. But we are not that dissimilar. The modeling thing is just to, build the intrinsic values, buy here, sell here, but it is pretty common sense.
Yeah. Okay. I think I have one last question. Okay. This goes to Georg. Actually, you presented your successes and failures over the last 6 years, whatever, a long time.
Some of them.
Okay, so some of them. I mean, you mentioned that, or I heard through between the lines that obviously leverage is an issue. I mean, today, I know that two of the investments you had, the one you mentioned was Credit Suisse, the other Monte dei Paschi. Would you still invest in banks after all what you've learned in the past?
I would certainly invest in private banks. And one of the mistakes in Credit Suisse was we saw the value of the private bank and we figured that they would solve the problems around everything else, but everything else ate the problems of the private bank. So yeah, I would certainly buy that. Commercial banks, yeah, I would. I'm not interested right now. I think they've had their run. We never say never.
Yeah. But you own a private bank right now, or?
Yeah, we own a little EFG.
EFG still, okay, good. So that was it. Thank you very much.
Thank you.
Yeah.
Thank you.